Hello, I'm James Flintoft. I'm Head of Investment Solutions here at AJ Bell, and I'm pleased to welcome you to this webinar on diversification. I'm not going to talk about it in theory, but I'm just going to look at recent market dynamics given what's been going on in markets and show how diversification has been beneficial to portfolios. I'll first go through a quick summary of who AJ Bell Investments are and what we do, and then move on to what's been going on in the wider economy, what's been impacting markets, and what that looks like from a diversification perspective. And then touch a little bit on how we're positioned and a bit of a summary of what we've covered today. So AJ Bell Investments was established in 2016. We've grown our AUM to 7.2 billion. Thanks to you, advisors and your customers. It's great to see that you and your clients are seeing a proposition that resonates with you. Our funds and MPS are available on our own platform, AJ Bell Invest Centre, but also available across third-party platforms as well. You can find out more about that on our fact sheets. Like most investment managers, we've won several awards over the years, and here's a selection of them for you to take note of. Our investment proposition is a commitment to choice, so we are agnostic in terms of what type of implementation you want to use. We offer a range of risk-targeted growth portfolios, whether that's passive funds or MPS, or active MPS, or a blend of the two, or responsible fund or the responsible MPS. Or on the income side, if you'd like to target a certain level of income, we've got two income funds, a passive version of those income funds, and two active income MPS as well. And all of these investment propositions are targeted at being simple, transparent, and low cost. In addition to these investment propositions, we've also got a money market MPS and a newly launched gilt MPS, which you can check out on our website. So first up, it's worth thinking about what's been impacting markets and from an economic level and what has been changed in the last couple of months. And all of that really centers around the US. There's been a lot of unpredictability out of there since the new administration came in. Since Trump entered the White House, there seems to have been daily announcements, particularly around trade and tariffs, with several executive orders coming out. And what we've seen is a lot of noise from there. That's impacting markets, it's impacting businesses, and they're starting to feel that uncertainty impact their business decisions. And that can have a real impact at an economic level. Furthermore, after Q1, we've had Liberation Day, the 2nd of April, where Trump announced several sweeping tariffs, which have been widely covered in the media. And that really shocked the market in terms of their speed and scale and how those calculations were made. And what that's led to in terms of the market turbulence since has meant that actually several M&A deals and IPOs have been cancelled or put on hold at the very least. Businesses have refrained from raising finance. And that's put a bit of a roadblock in the capital cycle for the US. Which has been really virtuous over the last couple of years. There's been a lot of talk of US exceptionalism, how the US economy is geared up for success. And all of this runs contrary to that point, really, and has started to raise fears over a recession for the first time, really, in over a year. If we look at the growth front first, and that sudden uncertainty that we've seen, if we think back to last year, 2024, early in 2024, people were still looking for a recession, especially in the US, as that long and variable lag of higher interest rates was expected to impact the economy. But actually, what happened through 2024 was broadly positive in terms of growth, and we didn't see that impact. And as those fears around growth subsided through the year, we came into 2025 in quite a buoyant mood at a market level, at least. The consensus seemed to be that growth would continue, that US exceptionalism would continue. And then suddenly we've had, as I say, this roadblock, a speed bump thrown in the way by trade policy, which has caused a repricing across markets due to the uncertainty. Now, the OECD have had a first go at what the impact of tariffs might be. If there was a 10% tariff across the world from the US, and they estimated that it'd be worth 70 basis points of US GDP over a 3-year basis. But the key there is actually that estimate was issued in mid-March, when some of those tariffs were looking to be 10% on a country-by-country level, whereas actually what we've seen since in Liberation Day has been gone much further. For example, tariffs on China are now well over 100%, and almost daily we're seeing negotiations played out in terms of what those tariffs will end up looking like over the longer term. Now, thinking back to Q1 actually, and that growth fear that started to rise in markets, a lot of that centered around the Atlanta Fed GDP Now model, which is an economic forecasting model. It consumes data as it's released and produces a forecast for what Q1 GDP will be. And as that was getting updated, the data was looking worse and worse, in contrast to what most of the consensus was looking like. Now, there were some flaws in that model. So as you can see on this chart here, relative to the actual GDP figure, there is a tracking error there. And the forecast looking ahead is looking deeply negative, and a big tracking from the tracking error versus the Q4 estimate. Now, there are some flaws evident in this model. As I'm sure you'll be aware, there's been a lot of activity in the gold market. There's been lots of imports into the US to try and get ahead of the tariffs. Central banks around the world have been trying to keep up with the orders. It's been well publicized that the Bank of England has been struggling to release the gold from their vaults in a timely manner. And that's actually impacted how this model has interpreted some of the data. So actually, on an adjusted basis, this model is looking less extreme, and it's just suggesting that growth is slowing, but it's certainly suggesting that actually the impact of tariffs is having an economic impact already due to the uncertainty that is created. And then if we just step back and think logically about this uncertainty and what it's causing at a business level, it is causing businesses to reassess their CapEx plans when they're going through their business planning processes. And logically, that means that growth will be lower over the short to medium term. If we flip to the other side of the equation, inflation, tariffs feel inflationary, don't they? It's uncertain how they're actually going to impact inflation and where it will show up and when, but it certainly feels like it's going to make an impact. We've been very focused on the vulnerability of UK inflation around this stickiness that we've seen in service sector inflation in the UK. The headline level has benefited from deflation in some parts of the goods pricing over the last couple of years. But the service side of the economy and inflation there is looking very sticky. And we focused on that vulnerability, used our short duration position to protect against any volatility in longer dated bond yields. Whereas actually now, given the conversations around tariffs, a lot of focus is now on US inflation. And that's where we've seen an uptick as well in the US. US inflation has been ticking higher. Not dramatically so, but it certainly looks like 2% is now looking like a floor relative to its history. And it is uncertain how high that will go over the short to medium term, but it feels like tariffs will have an impact, at least in the short term in the US. Over the medium to longer term, it depends on business level decisions. If you take, for example, US consumer goods companies, if they're facing higher costs of goods into the US, are they going to raise prices in the US significantly? Or instead, are they going to choose to raise prices globally by less? Now, it feels logical that they might do the latter because it's much more acceptable to raise prices by a lower value across the board rather than a significant value in one particular region. But until we see those business level decisions happen, we won't really know how inflation will play out. But in conclusion there on inflation, it's really looking like US inflation is looking as uncertain as UK inflation at the moment, and certainly as vulnerable as well. So how has this change in growth and inflation dynamics been repriced across markets? Well, if we go back to Q1 specifically, we started the year with fears over higher inflation in the bond market impacting yields. Yields rose quite significantly in January. Then growth fears took over and we saw yields come in a little bit, and actually a bit more risk being priced into credit markets. So we had credit spreads starting to widen a little bit into the quarter end. In equity markets, actually, yes, there was an impact in the US market. It started to underperform quite significantly, which I'll touch on in a minute. Actually, for the other regions, largely it was ignored. Some of the regional stories took over. So, for example, in China, there was a lot of good news around AI, again, which I'll touch on later. In Europe, there was a strong outcome from the German election. And then in the UK, we performed well as well, with some of our sector profiles showing through. Now, if we looked at kind of other assets, such as gold, people use as an alternative, that's been seen as a safe haven recently. That rose strongly. And some of this noise around tariffs and the fears over the US economy resulted in a weaker dollar, and we saw the pound appreciate versus the dollar, which is impactful for portfolios in the UK because overseas assets are based in dollars, or overseas US assets are based in dollars, so the price of those fall relative with that currency move as well. So if we look at fixed income markets over the first quarter, as I said, we saw the first signs of credit spread widening, some more greater caution in credit markets. Here I've shown on this chart our GBP hedged high yield exposure, which negated some of that currency issues that I mentioned before. That was a very good asset to hold through the first quarter, although the returns did soften as the quarter wore on. Then after that, actually, the best place to be was in cash, an asset that most people don't think of when they think about fixed income, but the yield on cash has been quite attractive recently, and it started to outperform government bond markets on a volatility adjusted basis. Return to equities, as I said, there was dispersion there in the equity space across different regions. China benefited from that AI theme with the announcement of the DeepSeek model on the 20th of January, really rocking the Magnificent Seven in the US, which I'll look to on the next slide. Then in Europe, as I said, that German election result produced a surprise in terms of the removal of the debt brake and actually greater appetite for fiscal spending around defence and infrastructure. Then the UK market performed well. Its sector profile was beneficial, which is what we look to when we look at the UK market. Banks and insurers performed well. Energy companies performed well as well, particularly oil and gas majors. So if we zoom in on the US in particular, here I've shown a selection of ETFs based around the Magnificent Seven. So a Magnificent Seven ETF, one that excludes the Magnificent Seven, and then an equal weight S&P 500 exposure like the one that we use in some of our portfolios, and then the broader market exposure by the S&P 500 ETF. And what you saw there is, since that 20th of January release of the DeepSeek model, DeepSeek R1 model, we started to see a significant underperformance of that Magnificent Seven, which dragged the wider US market down with it and really caused concern about the concentration in the US market and how that might impact returns over the medium term. We negated some of this by using that equal weight exposure through the quarter, and that was beneficial as we missed out on some of that downside in some of those names like Tesla, which fell nearly 40%. What you can see since the quarter end is actually the returns in the US have been much more uniform. We've started to see a bit more of a cyclical downturn. The equal weight product is more of a cyclically exposed product because it's smaller cap biased. It has a bit more of a value bias in there. Whereas the Magnificent Seven, growth-based companies, some very strong balance sheets out there, and actually have seen some special treatment in terms of tariff carve-outs in the last couple of weeks as well. So there is an argument to suggest some of those Magnificent Seven actually might start to outperform the rest of the market going forward if this cyclical downturn continues. And if I think about our portfolio positioning, that is exactly why we were particularly nuanced about our introduction of the S&P 500 equal weight product into portfolios. As part of our US exposure, we didn't take half of our exposure and put it into that product. We took between 10 and 20% of our US exposure in it, just to take the edge off the sector profile, to reduce the concentration risk in the US, to make sure that the volatility that we experience from our overall US exposure is more in keeping with what volatility we've seen from the US market historically. Historically speaking, if we take since 2006, the S&P 500 has experienced annualized volatility of around 14%, whereas an equal weight version of that index has been around 15%. So it is a more volatile product and more cyclical, as I mentioned, so we need to be careful with how we introduce that to portfolios, hence why we were very nuanced with our exposure. So how did broader markets react to that Liberation Day that you can see quite clearly on this chart here? Well, what we saw was a flashpoint in markets on the 2nd of April. We saw a rise in bond and equity volatility and contagion across some of asset classes, particularly US Treasury bonds came into focus as some leverage trades needed to be unwound in that space. On the positive side, this wasn't something over and above what we've seen in the last 10 years. Actually, COVID was much more severe in terms of its shock to the markets. And given the recent the bond volatility that we've experienced over the last couple of years, it wasn't really anything over and above something that we've seen recently. And when the dust started to settle after the first couple of weeks, we didn't see any players in the market go under, as it were, be forced into liquidation or our administration. We didn't see any hedge funds go bust in particular, great numbers or size, and we didn't see anything like regional banks falling over like we did a couple of years ago. So broadly speaking, yes, it was a shock to markets, but it wasn't a persistent shock that reverberated around markets. So specifically, what did that bond volatility look like? Well, it was just really reignited. I've shown a chart here on the right-hand side of the 10-year US Treasury note and its one-day range in terms of yield. So you can see that range was around 35 basis points at its most extreme recently, which is an extreme move in that market, don't get me wrong. But actually, it's a move that we've started to become accustomed to. As a lot of leverage is applied in that market by some hedge funds. They undertake what is called a basis trade, where they take advantage of the differential between the physical product and the synthetic product and apply a lot of leverage to it. And if there's a big swing in that market, they need to start unwinding those trades. And that's what happened here. We saw a big one-day move in this market. And when that happens, people naturally start to call into question its safe haven status. Does it really protect portfolios in times of stress? I think for shorter term investors, that's a perfectly logical question. But for us as longer term investors, we need to step back and think above this sort of level of noise. If we zoom out just a little bit here to get some perspective, I've just shown the weekly return that you've received from the US Treasury market versus the S&P 500. So the Treasury market on the y-axis, the S&P on the x-axis. And you can see in the top left that first week in April, we saw declines in the equity market through the Thursday and Friday, but bonds responded, yields came in. The bond market performed as you would expect, that negative correlation kicking in on the weekly basis. Then the following week, when a lot of that volatility in the bond market started to kick off, particularly on the Monday, as was a difficult day for equity markets as well, as we've just shown that one-day move in bond markets was quite extreme. But actually over the week, the equity market recovered. And although bonds were negative, that correlation held, that traditional correlation held. So bonds have given you some protection over this period, just on a slightly longer term time horizon than those that are thinking very short term. Now, if we zoom out even further and think about overall fixed income exposure, if you're diversified, you need to be less concerned about these individual sleeves and how they're responding to different market events. As you can see, there was a rise in correlation across riskier parts of the fixed income markets. As high yield was impacted, as emerging market debt was impacted, particularly by the dollar. And actually traditional government bond markets didn't give you stellar returns to offset those declines in riskier assets, but they at least held their value, which was useful. And all of this is to say that actually, although there's traditional safe havens in global government bonds held their value, actually you were much better off just holding cash or indeed shorter duration government bonds like we do in some of our portfolios alongside decent levels of cash as well. And that's really thinking about cash as competing with other fixed income asset classes. Given interest rates have been staying high for longer, the yield on cash has been quite attractive. If we look at equities and think about how they responded to that shock in markets, as you can see, some of them, sold off pretty aggressively, a bit more cyclicality to some of them. For example, China gave up a lot of its gains as a lot of the tariffs were focused on China. In other regions, EMX China, particularly India within that allocation, performed poorly because India is also a target of the tariffs. So too Japan, who is now negotiating with the US quite aggressively. So a lot more cyclicality in markets. And although they fell, actually, it was best that you were diversified on a one-year basis, that you benefited from those returns from the US market, as you can see kind of in the middle of this chart, looking at the green line, and maybe rebalanced away from the US. That would have been beneficial throughout the fourth quarter of last year and January this year. Rebalances around these types of events and taking advantage of this diversification can be key for portfolios and not being too focused on any one region. Even if markets are falling in unison, what you find is actually on the recovery, on the way out of any dip in markets, is that different markets perform differently, respond to different events differently, and capturing those returns for your portfolio is beneficial. Now, if you think about that diversification at a portfolio level and how our portfolios look relative to the World Equity Index, so I've just used the MSCI World ETF here, which excludes emerging markets, but it's a very popular exposure. You can see here that over 70% of that allocation is in the US, so very concentrated, particularly within that Magnificent Seven. Whereas if you look at something like our portfolios, our balanced or our global growth portfolio, we've got significant diversification away from the US. Yes, we do have exposure to the US, as you'd expect, but we've also got good exposure to other regions. Europe, for example, as I've shown, has had some decent returns recently. Japan, emerging markets as well, such as China, India, Taiwan, South Korea. And then the UK, which we think is an underappreciated asset class, really. When people think of the UK, they automatically think of active funds, their small and mid-cap bias that have perhaps struggled in recent years, but actually the wider market, the FTSE All-Share or even the FTSE 100, and its sector diversification that gives you can be beneficial to overall portfolios because it has a very different sector profile to other markets, and that's what we'd like to take advantage of in the UK. So if I think about all of this in terms of diversification and what's changed recently and what it means for our positioning, actually, on the whole, we're fairly happy with how we're positioned. We have been positioned within fixed income to protect against inflation by being short duration, by having US tips in the portfolio. Actually, we think that as growth softens and potentially interest rate cuts come on the agenda for central banks over time, that short duration positioning should be well positioned as well. So no real need to change our positioning short term there. Within equities, we're happy to be diversified as we always are. And we've added to that diversification in the US by using that equal weight product, as I've shown, but implementing that very carefully. And as I've just said, in the UK, we try to appreciate the sector diversification that gives you in terms of things like energy, financials, miners, etc. And then if I think about the credit side of our fixed income portfolios, yes, we've seen some spreads widen, particularly in high yield. We still have some exposure to high yielding portfolios, not as much as we did back in 2023 when we had double-digit exposure within the portfolios. But our focus at the moment is actually much more on investment grade. which we think has much more defensive qualities when it comes to any growth deterioration. And we feel that's what we're seeing at the minute, and we're happy to hold in investment grade for the time being, with some high yield exposure still in there to give us diversification, but also looking for an opportunity there in different parts of the credit universe. So in summary, on the economic side of things, we think growth will be impacted by tariffs. We think it's clear that businesses are feeling the uncertainty, are stalling their financing activities, are potentially putting off different capex plans. And on the inflation side, we think there's a lot more uncertainty there. It feels like there will be more inflation, particularly in the US. And what that's meant for markets is that, well, that US-centric nature of these shock announcements over the last couple of weeks has meant that parts of the US market have underperformed, the Magnificent Seven, particularly through Q1, but also the wider market through Q2 as well has been choppy as well. We've seen credit spreads starting to react to different growth forecasts. More caution there, which we think we might be able to take advantage of at some point in time. We've seen government bonds rocked a little bit by events in markets and the volatility, but ultimately they held their value, gave some protection to portfolios, if not over and above what some people might expect from them. And from our perspective, that short duration positioning really performed as we would expect. In terms of our positioning, as I said, we think that growth and inflation risk will offset in terms of our positioning, and we'll actually we'll stick with our shorter duration positioning, which we think is beneficial. We think within credit, it's good to be diversified as always in terms of our credit exposure, whether or not that's investment grade, high yield, or emerging market debt, but with a focus on investment grade. And then within equities, as always, we look to be diversified, and we feel that's increasingly important at present in markets, where it hasn't been for the last couple of years, given the strong returns that have been coming out of the US market. So that concludes this webinar on diversification. I hope you have enjoyed it. I've been James Flintoft, Head of Investment Solutions here at AJ Bell, and thank you very much.